We are weeks away from a major crash. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Bank of America analysts are now predicting that we are a matter of weeks away from the economy entering a major recession that will send stocks crashing and layoffs surging. But before we get to that, we have some breaking news coming out Friday evening on First Republic, as the FDIC, as we first reported on Friday on our show, that would likely be taking the bank into receivership, has now punted on that and is sending the bank to the auction block. We're going to take a look at why the FDIC backed off so quickly and what this means for the entire banking system going forward. Let's go to Bloomberg, where he picked today's story up with a headline: FDIC asked banks for the final First Republic bids due on Sunday. The bidding process started by regulators after weeks of fruitless talks among banks and their advisors that could now pave the way for a sale of First Republic. Authorities are stepping in after a particularly precipitous drop in the company's stock over the past week, which is now down 97% this year. So if you start from the first standpoint, is why would the FDIC bother to take over First Republic when the shareholders are now nearly completely wiped out, putting the bank at actually a very opportune price for a much larger bank to swoop in and buy it? But there's also the stigma now of the FDIC taking a bank into receivership. We'll talk about that in a moment, and perhaps the surprising reason why FDIC here is really backing off. Unclear to some involved in the process is whether regulators might use a bid for so-called open market solution that avoids formally declaring First Republic a failure and seizing it. And that's one of the key points that I want to make, is they don't want, or I'm going to say the regulators and the policymakers do not want to see an outright bank failure here, not after we already had Silicon Valley and Signature banks go down. A third one just doesn't look good to the public eye, because many of you in the comments talk about how we're eventually paving the way for a digital currency, or perhaps bank failures will cause people to move more towards them. But if you think about this from a government perspective, we know someday there will be a digital dollar, but one of the key tenets in making that work is everybody has to bank through a bank. And that means all the unbanked people have to start opening accounts. And if we start to see failure after failure coming in on behind the back of the global financial crisis, and we see it again, you can tell the general public will not be behind a digital currency, putting any integration of that years down the road. But the other reason we see the stock drop, leaving the company with a $650 million market value, has made the takeover at least somewhat more feasible, particularly to one of the big banks, because you can come in and wipe out all of the existing shareholders, you can wipe out a lot of the debt, and you can take over the bank for literally pennies on the dollar. Now, remember, before we talked about how the banks were looking, or at least First Republic was looking to sell its debt to the banks in exchange for some warrants on the upside of the stock. But if you look at it now, at its 97% discount on the stock, why would you even bother arranging that deal when you could just now let the bank fail, which it has, and come in and swoop in and buy it up on the cheap? As of Friday evening, the FDIC had yet to reach a decision on putting First Republic into receivership because, again, they don't want to. And I'm going to make the case here of the financial position in the FDIC is far worse than people know. And if they start making, a decision to take banks into receivership, it could cause the FDIC to fail during the next recession. Of course, we'll talk about soon how BofA says that's a matter of weeks away. Representatives for California's banking regulator, which would take the lead in declaring whether the San Francisco-based lender has failed, didn't respond. And of course, why would they? But receivership is an outcome the FDIC would prefer to avoid. One reason, the prospect would inflict a multi-billion-dollar hit in its own deposit insurance fund, will make the case where they really don't actually have a whole lot of money there to deal with it, and they don't want to actually blow through their deposit funds on saving one bank when we know coming down the road more are likely to fail. The agency is already planning to impose a special assessment on the industry to cover the cost of Silicon Valley and Signature Bank's failures last month as it is. But here you can see, I want to go look at the Fed's recent report of their balance sheet. And I've highlighted here other credit extensions. And if you go pull up this report, it's the H.4.1. What you'll find in other credit extensions, there's about $172 billion there. And what this is line itemed out as in the footnotes, that the Fed has lent money to the FDIC, which is guaranteeing loans to banks. So the FDIC is already sitting on $172 billion of liabilities that who knows what's going to happen during the next banking crisis here as this thing continues to likely get worse. What they don't need is more money sitting on the FDIC's balance sheet, because if something goes wrong there, well, guess who has to start writing a check? It has to go to Congress. And I guarantee you the last thing Congress wants to deal with is the FDIC overextending itself when it could simply broker a sale to a much bigger bank. And what this is going to turn into is stronger bank rules while detailing oversight lapses. Let's take a look at what's going on here, because the failure of Silicon Valley Bank demonstrated the need for stronger standards applied to a broader set of firms. This Barr, he is kind of the head of the banking regulations in the Fed. And so I want you to see that, we know why these banks are failing. We know why First Republic went down. They saw all these bank runs at a time. They had these unrealized losses, not just on their investment side of their book from their treasury securities, but from their loan book as well. And what do the regulators see? Do they see a problem here that says, hey, maybe it was the Fed's aggressive rate hiking cycle that put us in this position? No, the problem is we just don't have enough regulations, and we need a whole lot more. He went on to suggest that regulators could require additional capital or liquidity, limit share buybacks and dividend payments, or executive compensation at firms with inadequate capital planning and risk management. Again, completely ignoring the obvious reason we're in this problem. And of course, as many of you will probably agree, and you can weigh in the comments, do you think we just need more regulation here, or do we need the Fed, who is the king of the banks, to sit down and start to realize that there are actual ramifications for the decisions they make? Well, I'll let you decide who's right and who's wrong. At the same time, the report blames the approach under Barr's. Of course, we know this. Politicians are great at this. Policymakers are great. Blame somebody else, particularly someone who's not in power anymore. He blames his predecessor, Randall Quarles, who served as the Fed's vice chair for supervision between 2017 and 2021, that led the Fed's effort to tailor regulations for mid-sized and regional lenders following to the 2018 legislation that eased rules for those firms. So again, when in doubt, blame someone else. But it gets deeper than that as we head over to hear what Larry Summers, he's the former Secretary of Treasury. I was about to say Fed chief, but he was not that at all. These are things like forest fires. He says it is much easier to prevent them than it is to contain them after they start to spread. Well, they're starting to spread now. Now we have the third bank. He didn't offer a preference for the FDIC takeover, he said, but we need to figure out the answer to the question as soon as possible. And he went on to reiterate his view that an economic slowdown will be necessary to quash inflation. He also said there was perhaps 70% odds of a slowdown occurring within the next 12 months. Well, he's right. An economic slowdown will crush inflation. But according to Bank of America, well, it won't be a year from now. It's a matter of a number of weeks. A notorious recession indicator says that an economic downturn will begin this quarter. Strategists pointed to the inverted Treasury yield curves, namely the spread between the 2 and 10 and the spread between the 3-month and 10-year. Short-term yields surpassing long-term yields are a highly watched signal of an incoming recession, of course, unless you are a Fed chief. And then you deny it, and deny it some more until it stares you in the face and forces you to cut rates. While inverted, the 2-10 spread correctly predicted the recessions in 1990, 2001, and 2008, and now here it is again. The analysts say that historically a recession kicks off 6 months after the inversion of the 2-10s. Given those bond yields inverted in November of last year, the recession should be arriving in May, suggesting that now we are just a matter of weeks away from seeing the economy enter a recession. Let's take a look at the 2-10s and the 3-month 10-year yield curves. The 2-10s 2-10s in blue, the 3-month 10-year in red. We can see the inversion, see the gray lines, bars here. These are recessions. You can see the inversion, and on average, about 6 months later, you tend to get a recession. In fact, only in 2020 we had the pandemic, and now what we see the 2-10 steepening a bit. We see the 3-10 still heading a little bit lower, but how much longer? Well, will depend on the Fed. We'll get an answer to that, of course, on Wednesday. We can now expect the Fed will hike rates, and that will be the one and done now, and we'll see. And at that point, we should see the 3-10 start to steepen, but we'll find out more, of course, next week. The yield curve says recession starts now as markets await confirmation from the labor market. We'll look at that in a moment. Inverted yield curve signal recession, but once the recession begins, the yield curve immediately steepens as market discounts Fed policy in response to recession, meaning what it says is interest rates start to fall, with the short-term rates, the two-year, falling faster than the 10-year. That's where you get the steepening. In the case of the 3-month 10-year, the 3-month yields start to fall faster than the 10-year, and of course that means interest rates go down, bond prices go up, and next thing you know, you're in a recession and the Fed's cutting. Well, let's talk about the labor market here first. And here we have, again, the two yield curves, the 2-10s and the 3-month 10-year, same chart as before. Now we're going to overlap the 4-week moving average initial claims, because BofA is saying, look, layoffs, they're the last signal. Once they start to happen, this goose is cooked. We're definitely in a recession. And what do you know? Absolutely, this is happening. You see the inversion, and next thing you know, what happens? The 4-week moving average of initial claims starts to head higher. You see it happening in the late 80s, in the early 2000s, going into the global financial crisis, and now you're starting to see it again. And we know more of that is coming because now we're seeing almost on a daily basis more and more companies, hey, a few thousand here, a few hundred there, another couple thousand we're getting rid of. So all these people are eventually going to start to show up on the ranks of the unemployment, and validating that, again, we're now a matter of weeks away before a big crash. And what that would mean is after the Fed hikes on May 3rd, presuming that they do, the yield curve again accurately predicting that they're heading into a cut, and not just a little one, actually a series of large cuts will soon follow, according to what we're seeing in the yield curve. And sure enough, we see inversions followed by peak Fed funds rate over and over and over again, and we're going to see that here one more time. As strategists now have been warning that a recession over the past year, central bankers raised interest rates over 1,700% to tame high inflation, and it didn't work at all. Rates that high could easily push the economy into a downturn, experts say, particularly as the Fed officials signaled, as I said, they're likely to remain higher for longer. Of course, the yield curves are saying not a chance. It's telling all these central bankers all around the world, look, if you think that you're going to raise rates at least one more time and hold them, no, the bond market is telling you you may get one more hike in, but the next time it's a cut, it's not a little cut, you're going to be aggressively cutting because the economy is headed into a recession. And again, if BofA is right, and I think they are, this is now just a matter of weeks away of getting some sort of signal, and that will be from the labor market. As high rates are expected to continue weighing on employment and corporate earnings, which spells trouble for stocks, though equities are pricing just a 4% decline to corporate earnings, there's a risk these firms could face a bigger headwinds amid higher rates and a recession on the horizon. That, according to BofA, and what typically happens here is right around that first rate cut, or when the market starts to realize this is the last cut, you tend to see one last hoorah in the equity market, stocks surge higher. It doesn't happen every time, but it happens most of the time. And the next thing you know, as the yield curve steepens, enters that bull steepener, unemployment starts to rise. Well, next thing you know, the stock market starts to unwind. And that, my friends, is coming soon. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.